Stocks just got a new boss in town, and no, it's not AI this time. Kevin Warsh is now nominated to be the next Federal Reserve Chair, and that could reshape everything from interest rates to your 401k. Markets are already getting jittery. So, what would the legendary Charlie Munger think about all this? Let's break it down, without the hype, and figure out what it means for your money. So, what's happening exactly? Kevin Warsh has been nominated to succeed Jerome Powell as the next chair of the Federal Reserve. For those who aren't familiar with him, Warsh is a former Fed governor and a Wall Street veteran. He's got decades of experience steering monetary policy, and he was right in the thick of it during the 2008 financial crisis. He knows how the system works from the inside out. Now, Wall Street's reaction to this news has been pretty mixed. Some see his nomination as a sign of stability, bringing in a seasoned hand to guide the economy. Others are a bit more nervous, fearing uncertainty and a new wave of volatility. Whenever there's a leadership change at the Fed, the market holds its breath, and this time is no different. So, what would this actually mean for the markets? Let's look at this from a Munger-like point of view, focusing on common sense and long-term thinking. First, interest rates could become more flexible. Recently, Warsh has signaled support for lowering rates to help bolster economic growth. On the surface, that sounds great for stocks, especially growth stocks that thrive on cheaper borrowing. But here's the catch, Munger would point out. Cutting rates too fast or too far risks letting inflation get out of control again. It's a delicate balancing act. Second, we can expect markets to stay volatile for a while. Investors don't fully understand Warsh's playbook yet. Is he a hawk focused on fighting inflation? Or a dove focused on growth? This uncertainty almost always translates into market volatility. When the rules of the game might change, investors get nervous and markets swing. Third, his policy might focus on a unique combination, shrinking the Fed's massive balance sheet while also cutting rates. Warsh has talked about reducing the Fed's holdings of bonds, which is a form of monetary tightening, while simultaneously making borrowing cheaper through rate cuts. It's an unconventional approach. Put simply, the era of easy money might not be over, but the playbook is definitely about to change. Let's quickly ground ourselves with where some key stocks are trading right now, as of early February 2026, so we can look back later and see how these predictions pan out. Microsoft is hovering around $425 a share. Tesla is right there with it, around $426. And Apple is sitting at about $265 a share. Keep these numbers in mind as we dive into what to buy and what to avoid. So, what stocks should you consider buying now? Thinking like Munger, we want to find durable businesses with pricing power and real cash flows. These are the kinds of companies that can weather economic storms. Regardless of who is steering the ship at the Fed, Warsh's potential balancing act between easier rates and promoting strong economic growth could really favor these types of businesses. First on the list is Apple. Why? It has one of the strongest brands in the world and a massive loyal ecosystem of users. It's a cash-generating machine, and its performance isn't as directly tied to every little swing in interest rates as some other tech giants. People are still going to buy iPhones and use Apple services. Second, consider dividend-paying, recession-resistant stocks. Think about companies like Johnson & Johnson or Procter & Gamble. These companies sell essentials. People buy medicine, toothpaste, and household goods regardless of what the Fed is doing or where interest rates are. Their reliable demand provides a defensive cushion for your portfolio, and they often pay you a dividend just for holding their stock. Third, look at high-quality financials. This might seem counterintuitive, but banks like JP Chase or Goldman Sachs could benefit if Warsh manages to balance rate cuts with disciplined monetary policy. If credit conditions stabilize and the economy continues to grow, well-run banks are in a great position to profit. They are the circulatory system of the economy, after all. Now, let us talk about the other side of the coin, stocks to avoid or at least be very cautious with. In an environment with a new Fed chair and shifting rate expectations, high valuation stocks enter a danger zone. The first one to be cautious about might surprise you: Microsoft. Yes, this company has incredibly strong fundamentals and a dominant position in cloud computing and AI, but its valuation is also quite high. If rate expectations shift rapidly, the math that justifies these high valuations can change overnight. When growth valuations compress, even great companies like Microsoft can see their stock prices overshoot on the downside. It's not a bet against the company, but a caution on its price in an uncertain environment. Next up is Tesla. Tesla is a fantastic, innovative company, but its stock carries a lot of risk in this kind of market. It has a very high valuation, its sales are cyclical and depend on strong consumer spending, and its stock price is highly sensitive to what happens in the bond market. This combination makes it particularly vulnerable in a choppy rate environment where the future is less predictable. Finally, be very wary of purely speculative names with no profits, especially in the AI space. We're talking about companies priced entirely on a future promise rather than on current economics. When the Fed's playbook isn't clear, investors tend to flee from speculation and run towards the safety of real, tangible profits. These story stocks are the most vulnerable to a market reality check. So how would Charlie Munger himself distill all of this? With his classic wit and wisdom, he might say something like this: "Don't just ride the wave, make sure the wave doesn't wash you out." He'd remind us that volatility isn't our enemy. Our own lack of rational thought is. Under a new Fed chair like Kevin Warsh, we should expect the markets to be choppy and less predictable. But within that choppiness, there will be rich opportunities for patient, rational thinkers. The one thing that never changes, no matter who is at the Fed, is that confidence without fundamentals is a recipe for disaster. You can't just buy a stock because it's going up. You need to understand the business behind it and why it's worth what you repaying for it. That's the core of the Munger philosophy, and it's more important than ever in times of change. Let's boil this all down to some clear, practical takeaways for the ordinary investor. What should you do? First, favor stocks and companies that are strong cash flow generators. Cash is king, especially in uncertain times. Second, build your position slowly. Don't rush in and dump all your money into the market at once. Use the expected volatility to your advantage. Third, don't be afraid to cut positions that are causing you anxiety. If you can't sleep at night because you're worried about a particular stock, it might not be the right investment for you. Your peace of mind is worth more. And fourth, use market dips to average down on your high conviction holdings, not to chase high-flying prices. Be a buyer when others are fearful, but only in quality businesses. Now, what are the big things to avoid? First and foremost, avoid making leveraged bets on short-term rate movements. Trying to guess the Fed's next move is a gambler's game, not an investor's strategy. Second, stay away from momentum stocks that have no profits. When the music stops, these are the stocks that are left without a chair. And finally, the most important thing to avoid is making emotional, headline-driven decisions. The news will be full of panic and hype. Your job is to ignore the noise, stick to your plan, and think for the long term. So as we wrap this up, remember this key idea. Whether the new Fed turns hawkish and raises rates to fight inflation, or dovish and cuts them to spur growth, the fundamental game of investing doesn't change, but investor behavior does. Charlie Munger would remind us, invest like you're going to be around for 30 years, not 30 minutes. Focus on quality, be patient, and let the market's short-term craziness serve you, not scare you. Thanks for watching, and if you found this helpful, be sure to subscribe for more insights. See you next time.